The AI boom has created trillion-dollar winners in chips and cloud computing. But one of the most interesting beneficiaries does not build frontier AI models and does not sell GPUs. It sells the physical systems that make AI possible. Siemens just reported the highest quarterly industrial profit in its history. Industrial profit jumped 25% to 3.52 billion euros, revenue rose to 20.79 billion euros, and orders reached a record 27.9 billion euros. One of the biggest drivers was demand from data centers, where Siemens said orders in its smart infrastructure business grew at a triple-digit rate during the first 9 months of its fiscal year. That creates an important question. Why is a 179-year-old German industrial company suddenly benefiting from one of the newest technology booms in history? The answer is that AI data centers require much more than processors. Everyone sees the chips. Siemens is selling much of what surrounds them. Imagine a company ordering thousands of AI accelerators for a new data center. Those processors may cost billions of dollars, but they are useless until electricity reaches them safely and continuously. Power has to move from the grid into the facility. Voltage must be transformed. Electricity must be distributed across individual halls and server racks. Backup systems have to react immediately when something goes wrong. Cooling systems must prevent the processors from overheating. Sensors have to measure power consumption. Software must coordinate equipment across the building. The more computing power a company installs, the more complicated this infrastructure becomes. This is where Siemens enters the story. Its smart infrastructure division sells products and systems used to distribute electricity, automate buildings, manage power, monitor energy consumption, and control industrial facilities. In the latest quarter, orders at Smart Infrastructure jumped 42% on a comparable basis to 8 billion euros, driven partly by several large data center contracts in the United States and Europe. Revenue increased 13% to 6.4 billion euros. That means Siemens is benefiting from AI without needing to predict which model wins. OpenAI can win. Google can win. Anthropic can win. A new company that does not exist yet can win. They may all need more data centers. This is a classic picks and shovels business. During a gold rush, selling tools to miners can be safer than trying to discover the gold yourself. Siemens is supplying part of the electrical and industrial foundation beneath the AI economy. But electricity is only the first layer. Modern data centers are essentially enormous factories for computation. They contain thousands of machines that must be monitored, optimized, maintained, and coordinated. That makes industrial automation increasingly important. Siemens has spent decades developing systems for factories, power networks, railways, buildings, and industrial equipment. The same expertise can now be applied to data centers. A facility operator needs to know which systems are consuming power, which components are overheating, when equipment may fail, and how to reduce electricity usage without disrupting computing workloads. Every percentage point matters. If a small office wastes 5% of its electricity, the financial impact may be manageable. If an AI campus consuming hundreds of megawatts wastes 5%, that can represent an enormous operating expense. This gives Siemens another opportunity. It can sell software and automation that make the infrastructure more efficient after the hardware has already been installed. And this is where the company's strategy becomes more interesting than simply selling electrical equipment. Siemens has been transforming itself into a combination of industrial hardware and software. Its Digital Industries division reported 10% comparable revenue growth in the latest quarter, while software revenue increased 15% to 1.8 billion euros. Profit at Digital Industries surged 44% to 923 million euros. Siemens also said its digital business grew 18% during the first 9 months of fiscal 2026. The company wants a customer to buy the physical equipment, then continue paying for the software that helps design, simulate, monitor, and optimize it. That changes the economics. Selling a piece of electrical equipment may generate revenue once. Selling software subscriptions and digital services around the equipment can create recurring revenue for years. This is similar to what happened in the technology industry. Hardware companies once made most of their money when a customer purchased a machine. Over time, software and services became more valuable because they generated recurring revenue and made customers harder to lose. Siemens is applying that logic to factories and infrastructure. One example is the digital twin. Before building a physical facility, engineers can create a detailed virtual version of it. They can simulate electrical loads, test production layouts, examine cooling requirements, and identify problems before construction begins. For a normal factory, that can save money. For a multi-billion-dollar AI data center, avoiding one major design mistake can be extremely valuable. Then AI adds another layer. Siemens is increasingly connecting industrial data with AI systems that can help engineers analyze equipment, automate tasks, and identify problems. Its latest investor presentation highlighted Intelligence Center X, which connects industrial data, workflows, and AI agents inside a governed system. So Siemens is benefiting from AI twice. First, the AI boom creates demand for new physical infrastructure. Second, Siemens can put AI inside the software used to operate that infrastructure. This helps explain why the company's current results are unusually strong. Total orders reached 27.9 billion euros in the quarter, while revenue was 20.8 billion euros. That produced a book-to-bill ratio of 1.34. In simple terms, Siemens received significantly more new business than it delivered during the quarter. Its total order backlog reached a record 132 billion euros. That backlog matters because it provides visibility into future revenue. A consumer internet company may lose users quickly. A large industrial order behaves differently. Building an electrical system, rail network, factory, or data center can take years. Once Siemens is selected, the relationship may continue through installation, maintenance, upgrades, software, and expansion. This gives industrial companies something technology investors often underestimate: long-duration customer relationships. But there is a twist. Siemens shares fell more than 5% after the results, even though the company reported record profit and raised its earnings outlook. The reason is similar to what has happened with other AI-linked companies. Expectations have become extremely high. When investors already expect a company to benefit from AI, excellent numbers may not be enough. They want acceleration beyond what is already reflected in the share price. Siemens now faces the same problem as semiconductor companies. Success creates a higher standard. There are also real risks behind the data center boom. The first is overbuilding. Microsoft, Meta, Amazon, Google, Oracle, and other companies are committing enormous amounts of capital to AI infrastructure. If future AI models become dramatically more efficient or demand grows more slowly than expected, some planned data centers could be delayed or canceled. Siemens does not need to predict AI model performance perfectly, but it still depends on customers continuing to build physical infrastructure. The second risk is electricity. AI computing requires enormous amounts of power. In many regions, the limiting factor is no longer land or chips. It is access to the electrical grid. That can actually help Siemens because grid constraints create demand for electrical equipment and energy management systems. But it can also delay projects. A company may have billions of dollars ready to invest but wait years for a grid connection. The third risk is competition. Schneider Electric, ABB, Eaton, and other industrial groups are also benefiting from data center electrification. Everyone wants to become a supplier to the AI infrastructure boom. Siemens must therefore prove that combining electrical equipment, automation, industrial software, and AI creates more value than buying those products from separate vendors. Its large installed base could help. A customer already using Siemens systems inside factories or buildings may prefer to extend the same technology rather than integrate another platform. That is the same ecosystem advantage seen in software companies, but applied to physical industry. Siemens is also expanding production capacity specifically for AI infrastructure. The company has announced additional manufacturing investments in the United States to increase production of critical electrical equipment, strengthening a portfolio that includes power distribution, automation, digital twins, electronic design automation, and industrial AI. This reveals how seriously management views the opportunity. It is not simply waiting for extra orders. It is building factories to serve them. The broader lesson is that the biggest economic winners from artificial intelligence may not all look like AI companies. Some will manufacture transformers. Some will build cooling equipment. Some will supply power management systems. Some will construct data centers. Some will sell networking. And some will provide the software that coordinates everything. The more powerful AI becomes, the more physical infrastructure it requires. That is the paradox. Artificial intelligence feels like a purely digital technology, but scaling it requires enormous quantities of very physical equipment. Steel, copper, transformers, switchgear, cooling, factories, electricity, and industrial automation. Siemens spent most of its history building technology for the physical economy. Now the digital economy is becoming physical enough to need Siemens again. The company's record quarter does not prove that every AI investment will succeed. It does show where a large part of the money is already flowing. Before an AI model can answer one question, somebody has to build the infrastructure that keeps the machines running. Siemens is betting that no matter which AI company wins the intelligence race, someone will still have to power the computers.